Let's go to the true-false question.
Got a good one today. Since the S&P 500 did very well in 2014, 14% with reinvested dividends, I should shift my money to an S&P 500 fund because it's currently a hot investment. And we get this question all the time, and I'm going to say false for a number of reasons, but we have a special guest today that's really going to answer this more fully. And with that, I would like to introduce Matt Balderston. He's a CFP and was our first advisor with Pure Financial Advisors. Welcome, Matt.
All right, thanks, Al. Yeah, the answer is absolutely false. Chasing the hot trend, trying to buy something when it's high, putting all your eggs in one basket. I don't know how many cliches I can probably say to describe why that's such a bad idea.
Yeah, well, but that's what we all want to do, right? I mean, we want to buy last year's winner, and history tells us that that's not necessarily the best way to go.
Exactly. They even have a term for it. It's called recency bias. There's a lot of study that's done on why people do that. And I think this year it's going to be particularly dangerous because the S&P 500 was, one of the top asset classes of all of them, and it's the one we see every single night on the news, and people want to jump in on that. And that's, tracking bias is another one of those phrases you'll hear when you want to be in the index that you track most frequently.
So anyway, so the S&P 500 we know did well last year, and a well-diversified, globally diversified portfolio did not do as well. So people are questioning, is that really the best way to go?
Oh, exactly. I've heard that quite a few times. And ultimately, when you look at the total range of asset classes you can invest in, the S&P 500, like I said, was one of the best. Most things returned more around 0 to 4%. And when you start getting into the international markets, you're talking about -4, -6, depending on what index you're tracking. So when you take the average of all of them, yes, you ended up with 2 to 5%, depending on what your actual mix was. But that's very normal. In the last 25 years, about 8 of the 25, a balanced portfolio probably performed less than 5%. And yet on average, but on average, you're still going to see a 7 to 9% return over that period of time.
Over the long period of time. And I got this question probably a month ago, which is, well, it seems like international has not done so well the last several years. Domestic has. So why don't we just load up in domestic? Clearly, it's a winner.
Oh, clearly. Well, if you actually go back and look over the last 20 years, the U.S. has beaten broad international indexes 10 times, and international has beaten the U.S. 10 times. It's a 50-50, so it's basically a coin flip. Sometimes you go through long stretches where 5 years in a row one beats the other, but a lot of times it'll alternate back and forth. The thing is, nobody knows, so why jump into something that's hot when next year could be the worst?
So what about this one, Matt, which is, well, okay, well, S&P 500 did well last year. Can't we predict what's going to do well this year?
Oh, yeah, that would be wonderful. I think we'd all be on our own private island somewhere if we could really do that instead of here. The S&P 500, just a great example because it has done well historically. And if people feel that it's the right place to be, you just have to go back to the year 2000 to find out why you don't jump into something like that. Because from 2000 to 2009, people have heard the term lost decade. That's because the S&P 500 actually lost 10% during that 10 years. It's about the only asset class that lost money, though. So it was only a lost decade for people that were only in that holding.
Yeah, I think that's a really good point. So this last decade, which if you kind of know about the stock market, S&P 500 actually went down over that 10-year period. In fact, $1 million investment would have ended up around $900,000, a little bit more in that 10-year period. Yet, what if you had a fully diversified, globally diversified portfolio? What would have been the return?
Depending on the mix that you had, I would say it's somewhere probably between 5.5 and 8. It really depends. I mean, more equities, more international exposure, small company stocks, all of which had really good, a really good decade. It's just the S&P 500, but again, that's what people see, so that's what people want to talk about.
Yeah, so I think it's well said. And if we could predict which would be the absolute winner, we'd know exactly what to invest in, but no one can really do that.